Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer, and today we're going to be doing a dividend analysis of American Electric Power Company. I thought the dividend analysis would be a good way to go on this one since it's a utility, and probably most of the people who are going to be thinking about investing in it will be looking for kind of a stable dividend payment. This one came in by request down in the comment section of one of my other videos. If you have a request of a stock you would like me to analyze, just drop it down in the comment section. I will get it on my list, the ticker on the whiteboard behind me, and eventually I'll make a video. If it's a stock that's in the S&P 500, I post all those on YouTube for free, and sometimes I'll post an extra bonus one or not. I actually didn't even check to see if American Electric Power was or not, because it's a pretty simple analysis. If it's not in the S&P 500, I post all the rest of the videos on Patreon and in the full Cyclical Investors Club service on Seeking Alpha. Patreon's $5 a month, and if you join there, you can get a big discount if you ever decide to join the full service Cyclical Investors Club, where I have several different strategies, 5 in total that I combine together. The dividend strategy is one of those that I'm going to share here. And then you can chat with me, direct message. There's a chat room. There are other wonderful, very smart members there to help us sort through any new ideas that come along. And I have all the strategies there explained, and dozens of over 100 articles actually that aren't available to the public. So you can consider joining there. Those links are in the description. I'm also going to be using fast graphs really for the majority of this dividend analysis. It's pretty good for that. And I have a 25% off link if you are interested in trying out fast graphs, particularly for earnings-based and dividend-based investors. Fast graphs makes things really fast rather than looking up everything in earnings reports and things like that. As always, this isn't individual investing advice. This is just how I analyze stocks. So let's get in and do a dividend analysis of American Electric Power. So the first thing I like to look at are the earnings history, which is this dark green shaded area here. And there have been a couple years here in the Great Recession, during the recession before that, in 2017, where earnings growth came down just a little bit. But for the most part, earnings growth has been very steady. And then when we bring this to more modern times here, we can see that this is pretty straightforward, generally speaking, unless some big disaster comes along. These guys, I'll show you what my earnings growth calculation is here in a little bit, but you're looking at 5 or 6% earnings growth, depending on whether you want to count this or not, this downturn, which I do. And then we'll look at the dividend has grown very steadily as well. Okay, so we had a period here where if we just look at the valuations, and this happened for all types of dividend-paying stocks that I kind of harp on over and over, we really have like a dividend bubble kind of going on where people are paying like over 20 times earnings for 5% growth or something, earnings growth or something like that, which is very, very, very expensive, right? So the type of dividend analysis that I'm going to do now tries to look at this from like a little bit of a different angle in how long would it take an investor to earn their money back just from the dividend and dividend growth. If they invest, so if you invest $100 or $1,000 or $10,000, whatever, how long would it take to earn an equal amount back just from the dividend? And stocks that have very steady dividends like this one make it relatively easy to do that, and you can avoid kind of a lot of other calculations and thinking and things like that. You can just say, oh, do I think it's fair that am I willing to wait that many years to get my investment back, an amount equal to my initial investment back? And sometimes it can kind of frame things in a way that just where a person can kind of think about it in a little bit different way that's not super. Usually I'm showing CAGRs and things like that. That's not super complicated. It makes it quite simple, actually. So that's kind of the goal here. Now, what we've seen lately is this 20-something PE has come down to 16. It was even down to under 14 anyway, a couple months ago. So we're getting into a range here that makes it a lot more interesting. Okay, let's see. Down about 20% from that high back there. Okay. All right, so the way to do this, we basically need two things. We need the dividend yield, and we need the dividend growth rate. And if we have those two things, we can calculate how long it would take us to earn our money back from the dividend, from just the dividends. Doing an analysis like this also can allow you to kind of ignore the stock price. I know a lot of dividend investors find that that's one of the attractions of dividend investing. I'm not a dividend investor, but I created this analysis to kind of frame things a little differently. I do buy some stocks for dividends sometimes, but lately they've been so expensive I just haven't been able to find any. Okay, so we have a dividend yield. I'll actually go to my calculations for the dividend yield here. So here's the dividend as of last year. So this isn't forward looking. But I do pull forward, when I start calculating this, I pull forward the first year's earnings growth rate. So that will come into play at that point, right? So this is what they've actually already proven in dividends that they paid out last year. That makes, instead of that 4.14%, 4.14% dividend yield, that creates a 3.97% dividend yield instead. So both about 4%. The earnings yield I have, after I account for this little dip here, let's see what FastGraphs is. FastGraphs is at 5.06%. Once I account for that little downturn, I get 4.96% for the earnings yield, for the earnings growth rate. So a little bit more conservative here. And I actually have a video out that's in a playlist where you can watch how I calculate that, how I adjust for that down here. Most people do not do that at all. They will start, and FastGraphs does this too, because it's easy. You start with this point, you go to whatever point you want in the future. Maybe you're looking at forward earnings, or I think FastGraphs uses the blended earnings, and you measure from point to point, and then that's what your earnings growth rate is, and that's where they got the 5%. But one of those years didn't earn enough. Like it almost happened in a straight line, which is kind of nice to look at utilities because they do that. But it didn't. It had one year where earnings were less. So if you were just collecting those earnings, you actually wouldn't have collected a smooth amount the entire time. You would have collected a little bit less in earnings, right, this year. So I take that into consideration. Almost nobody else does. And that's why I'm slightly lower earnings growth rate, right? So now we need the earnings growth rate as part of the calculation to estimate future dividend growth rate. So you might ask, well, why do we care about the earnings? Well, dividends come out of earnings. So if the dividend growth rate is at an unsustainable level, like higher than earnings, that is not going to be sustainable over the long term. All other things being equal, they can borrow money. There's a lot of other things they can do, but the simple way is, look, first you earn the money, and then you pay some portion of that money out to shareholders in the form of the dividend. So over the long term, which these calculations are all going to be long term, you're going to earn, you're not going to be able to grow dividends forever faster than you can grow earnings, right? Especially if the payout ratio is over 50%, and these guys are just over 50%. So if you're just starting to pay dividends, like your Meta or I think I saw Salesforce was starting a dividend, so they could grow their dividend at a rate quite higher than earnings growth until they start getting close to that, above 50% payout ratio. And usually companies try not to exceed 80% payout ratio, so they have some kind of cushion in case earnings go down in a recession or something, and they can still. In America, they really like to kind of pay steady dividends. If you go to Japan or someplace and there are companies in America that do this as well, they'll adjust the dividends to how earnings are going. But in America, for whatever reason, we just want dividends always rising and So companies do what they can to try to do it, and that will often mean they'll have a lower payout ratio to get a cushion between the earnings and the dividends. But yeah, if you ever see anybody using like an earnings growth rate and then tacking it on to the dividends, that's not the best way to do it. You want to you never really want your assumed dividend growth rate over the long term to be higher than what they actually earn in earnings growth rate once we get over a payout ratio of 50%. So that's what this little exercise is designed to do. So in this case, the payout ratio is over 50%, and the dividend growth rate is bigger than the earnings growth rate by a little bit, not much really. So I limit, instead of using 5.97% dividend growth rate, I use the more conservative of the two, which is 4.69. Now, if this would have been a payout ratio under 50%, then I average these two together to get some sort of middle ground estimate on how long-term 15, 20 year, 10, 15, 20, 25 years from now, they might actually be able to grow it if they can keep growing. Any utility might be able to actually do it that long. So when I do that, I assume that these dividends can grow at 4.69%, and that's how I arrived at that estimate. It's based on what they've been able to grow earnings, including the down years of earnings growth. So you generate a little bit of, and when the numbers are low like this, I mean, 1.5% is a lot, or 1.3% or whatever. That can be a lot of difference over the very long term in terms of what you're going to expect from your dividends, right? So back to the beginning here. We have almost a 4% dividend yield. So the way I like to think about this is, if I bought this business for $100, it would pay out that $3.97, and then it would grow at that 4.69% rate. And then this is going to be year one. I have my face covering some of this. Let me move this just so you can see the titles we're dealing with here. So this is the rate. This is after the first year. So the first year you would collect $4.15 on your $100. The next year, $4.35. The next year, $4.55. And this is what you would collect each year from your dividends. And we want to know how long it would take for all these to add up cumulatively to $100, right? So if we go back to here, I start this on year 5 because no dividends are usually high enough to return any sooner than that. So I just eliminated the first 5 years. So after 5 years, you would be at, this includes your original $100. You would have earned $22.80 in dividends, and then year 6 you would have earned $28 in dividends. Year 7, okay, so I want to know at what point this reaches $200. I want to start with 100. I want to end with 200. That's how long it took me to earn an equal amount back that I invested, and that is year 17. Okay, maybe 16 and a half if you want to be more specific. So at that point, it would take you 17 years to earn an amount equal to whatever your investment is. I just use $100 because it makes the math a little simpler and it's easy to explain, but it could be $1 million. In order for you to make another $1 million in dividends, it would take 17 years. So each investor kind of has to make up their own mind whether that's satisfactory for them or not. My threshold is 10 years, so we're a long way from that. Personally, I think if a person was really focused on dividends, 12 years would probably be okay, especially in the current environment that we're in. And 17 would probably be in a hold range for me. Up here I have an ETF. This is a 60-40 ETF, which is what I think is the best benchmark for dividend investing, dividend growth type investing. And it would take 20 years to earn your money back in that. That's the estimate from the dividends, right? So, and they have a faster growth rate, 7%, but a lower starting yield at 2.43. So that's how that works. So from that perspective, as a relative value, if you consider dividend growth to be similar to 60-40, which I do, then as a relative value, this is a little cheaper than like a 60-40. But I do think right now 60-40 is a bad allocation to begin with. Well, one, you can see it would take it's not just a dividend investment necessarily, but it would take a long time, like double the time that I would prefer if I was buying, right? So on a relative basis, it looks okay. I would probably just generally rate this as like a hold if the dividends is really what a person was after. And if you think about it, I mean, it kind of makes sense. It's at a 4% yield. You think of like the 4% rule when you're in retirement. If you had the profile of something like this, where you can get your 4% dividend and then grow it at a rate of inflation over time, inflation's probably going to be 3% long term, plus any spikes that we have along the way, which usually there's, but minus any deflationary recessions that we have along the way as well. So, but there's going to be more risk with electric utility as with something else, right? So we've already seen lawsuits from wildfires. Occasionally, these utilities will make horrible, huge capital expenditures. And when you're talking over the course of 17 years, the odds of that happening grow and grow and grow, right? The longer you go, the longer somebody's going to screw something up or some bad luck event is going to happen. Whereas with a 60-40, you have a little bit less chance of these one-off kind of things. So to have a little bit of cushion in the growth rate, if you think inflation might be at 3, you got a little bit of a cushion there, doesn't make it any cheaper, I would say. It just kind of is trying to take into account that there is definitely risk that goes beyond just looking at these basic numbers. So yeah, when you put it all together, that's probably some type of hold that's a decent relative value and probably a little overvalued as a general rule based on historical type of dividends that you've been able to get. Because right now, with no risk, you can get 5.4% over the next year or so in treasuries, short-term treasuries. So you get 4% that grows a tiny bit, and then, or you can get a guaranteed 5.4. For me, the guaranteed 5, give or take, right? The guaranteed 5.4 is more valuable, but because I can take that and I can invest it. I can invest it in stocks if they ever get cheaper. But if a person wanted to keep things simple, then they could do something like this. If they already owned it, it doesn't seem like you'd have to rush out and sell it or anything. Okay, hopefully that helped everybody kind of frame things, think about things in a different way. If you have a request, if you want a specific dividend request, you can put that in the comments too when you drop the ticker. I just kind of pick and choose what type of analysis I want to do if it fits into more than one type. I had a couple other utilities I did as earnings analysis, and so I figured I'd do one as a dividend. All right, thanks for watching, and I'll see everybody later. Bye.